Hey guys, welcome to the Silver Report. Here we are, it's Monday, March 13th, 2017, and let's get right into some of the economic factors that will be playing a part into the price of precious metals, because we know that these computers are operating the trading whenever it comes to Wall Street. Yes, everyone wants to be Wall Street bulls right now. They want to put their money while the market is the most overvalued in history. This is the most overvalued stock market on record. But these machines are also triggered to buy silver and gold on dips. So it's even worse right now than 1929, the most dangerous and overvalued stock market on recorded history. It's worse than 2007, it's worse than 2000, and it's worse than 1929. Presently, we observe the broadest market valuation extreme in history. The steepest median valuations on record, the most reliable capitalization weighted measures within a few recent of their 2000 peaks. On top of such warning signs and extreme valuations, bullish sentiment, consumer confidence, market actions has deteriorated in interest-sensitive sectors. As of Friday, more than one-third of stocks are already below their 200-day moving averages. Don't be fooled by the booming headline indexes. More New York Stock Exchange stocks hit new 52-week lows last week than new 52-week highs. The companies that are really pulling this rally have been the banks, and it's no surprise seeing how some of these regulations and some of these laws that have been so focused on have been particularly centered around banks, around the freedom of banks to lend, the freedom of unregulating of banks. All of these laws seem to be focused on how to benefit banks, because that's supposed to benefit the economy. And also Visa and Apple as well. So they're not necessarily betting on a border tax anytime soon. And even if they are, it seems like people have just lost their mind. They're just following headlines. They're following whatever the Wall Street Journal comes out and tells them to put their money into. That's why so many people jumped onto Snap, and now it's below what it opened up at. They lost money by following these people you're trusting with your information and with your hard-earned money. By listening to what they tell you, they make money off of it. But believe me, they were among the first to hit sell. And so, a lot of people want to criticize what's going on. Notably, what we see taking place is very similar to what happened in 2000, 2008. Right before the crashes, they happened. And so, according to the World Bank, the total U.S. stock market is now valued at more than 150% of annual gross domestic product. That's way above historic norms. And it's about the same as it was in the market extreme of 2000. We had covered this recently in a different video, describing the fact that whenever you look at earnings and look at profits, that the average stocks were above 20% of what the company earns, what they should expect to earn. Everybody wants to play the winners. They want to put their money to these banks, invest in these banks. In all reality, they knew the laws that were going to be passed. That's why their money was there first. That's why these laws were passed. It's a private club, and you're not in it. You understand? And yet they want to tout the headlines in front of you. They want your money in. They want everybody to have skin in the game right now. In fact, there's more money it's a record amount of money that has been on the sidelines that has now moved into the stock market. This is a measure that Warren Buffett has praised as a good indicator of whether stocks or not are overvalued. When he says that people are enthusiastic, have fear, and yet it's not translating through to the basic investor. And so what we've been seeing is misrepresented facts about our economy. Market veterans, they note that even if Wall Street is overvalued, as some of these things suggest, there's nothing to prevent it from becoming even more than before any correction. That's what happened in 1929, 2000, 2007, and 2008. But the more valuations get stretched, the more dangerous it becomes. Because what we're facing right now, 150% overvalued. That means that they are not going to be having the kind of returns that people are expecting. People are just putting their money on there based on some sort of wave, based on headlines you're seeing from these mainstream media pundit talking heads that are telling you where to put your money. And as a result of the stock market tank, the same computers that push money and push stocks up are going to push gold and silver as soon as this market begins to roll over, as we already see it beginning to do. And during this crash, which we're long overdue for a correction, long overdue, months and months overdue for a correction. And when this begins to tank, you're going to see a dramatic rise in the price of silver and of gold. Investors will move quickly. It's already in their mind. We saw the volatility index. It was running high last week. People are already prepared. This whole market, with so much bullish sentiment, is already prepared to move at once. All right, thank you guys for joining me here on the Silver Report. If you like the content, be sure to subscribe, like the videos, share the videos, get the word out. I thank you guys all so much for stopping by. As always, stay safe.